Ford is under pressure all day after announcing price cuts to the Ford F-150 Lightning. Ford is in trouble. Big trouble. The kind that doesn't just dent a reputation but threatens to crush it entirely. Just a few months ago, Ford was riding high, hailed as the backbone of American manufacturing during Trump's second term. News outlets couldn't stop praising its revival. Dealerships were packed with eager buyers. Ford trucks were flying off the lots, or so it seemed. That glossy picture was a mirage. Behind the scenes, something was going terribly wrong. Lots began overflowing with unsold trucks. Loyal customers walked away disillusioned. Dealers begged Ford to stop sending more inventory, but the response was cold and calculated. Keep pushing, keep selling. Meanwhile, across the border, Canadian Prime Minister Mark Carney was pushing for an electric revolution, making Ford's reliance on combustion engines look increasingly outdated. How did Ford's epic comeback story turn into a full-scale disaster? And can they pull off a miracle to stay relevant, or is this the end of an era? You're about to find out. Reality hits the lots in the US, where Ford trucks had long been synonymous with strength. A new reality was taking hold. Drone footage from the Midwest revealed vast expanses of grassy fields cluttered with rows of unsold F-150s. Some dealerships were so overstocked that they began storing trucks in unconventional spaces, like a retired baseball stadium in Texas. In Vermont, a small dealership struggled to balance its floor planning interest payments as revenue continued to dwindle. The data told an unsettling story. Inventory days to turn had hit the highest level since 2009. Rural lots were the first to overflow, but soon the problem spread to urban flagships. 6 months later, big city dealerships once crowded with eager buyers were echoing with silence. Dealers across the nation began pleading with Ford to slow down production. A particularly tense conference call with regional managers turned into a desperate appeal. One dealer from Ohio practically begged, saying, "We don't have room, we don't have buyers, please just stop sending us more trucks." Ford's response was a flat refusal, insisting that volume targets must be met regardless of current conditions. It wasn't just a logistical nightmare, it was a cultural shock. For generations, Ford trucks had embodied the spirit of hard work and reliability. Now they were lined up like forgotten relics, gathering dust and weeds. Meanwhile, rumors swirled that Ford executives were deliberately ignoring dealer feedback to maintain shareholder confidence. Yet as more trucks arrived and fewer left the lots, it was clear the situation was spiraling out of control. Amidst the chaos, Ford made a decision that seemed unfathomable to many. They raised prices on their 2025 models. The company's finance team justified it by pointing to inflation and Trump's renewed tariff regime on Chinese batteries. Buyers, however, saw it differently. They felt betrayed. After enduring years of pandemic shortages, many had waited patiently for their chance to buy the iconic Bronco. One Ohio family, on a waitlist for 3 years, finally saw the price of their chosen Bronco Outer Banks model rise by $6,000 just weeks before delivery. Disheartened, they walked away, feeling that Ford had taken advantage of their loyalty. Ford's internal messaging spun the hike as a value realignment, but outside the corporate bubble it was a different story. Marketing slides aimed to rationalize the decision, suggesting buyers would perceive higher prices as a mark of quality. In reality, it was a blow to trust. Social media lit up with angry posts, and dealership phone lines buzzed with complaints. Wall Street didn't buy Ford's narrative either. Analysts quickly downgraded the stock, forecasting a long-term loss of market share. The price hike had triggered a backlash that reached beyond consumers and into the financial heart of the company. By trying to maintain margins, Ford had inadvertently pushed its most loyal customers to rethink their brand allegiance. As the fallout from the price hikes intensified, a sense of rebellion brewed among Ford's dealer network. Local dealership councils convened emergency meetings and the tone was uncharacteristically hostile. One group in the Midwest even drafted an open letter accusing Ford of corporate sabotage. We dug deep into Ford's unraveling, sifting through dealership data, insider leaks, and financial reports to get you the real story. Now you know why the iconic F-150 is gathering dust instead of dominating the roads. If you appreciate the effort that goes into uncovering these industry truths, consider subscribing. In an effort to move inventory, some dealers resorted to under-the-table discounts, violating franchise agreements in the process. As word spread, Ford's legal team began sending warnings, threatening to revoke dealership licenses for non-compliance. The situation worsened when Trump's Justice Department hinted at investigating dealerships for potential tax abuse tied to unsold inventory. At one dealership in California, the atmosphere was tense as auditors combed through sales records. Meanwhile, the competition sensed an opportunity. Representatives from Subaru and Chevrolet were seen handing out coffee and flyers outside Ford showrooms, subtly encouraging frustrated customers to consider alternatives. The tipping point came when a viral TikTok captured a frustrated dealer spray painting "No More Broncos" on a showroom banner. For Ford, the dealer rebellion was more than just a PR disaster. It signaled a break in the chain of trust that had long connected the automaker to its retail network. If the company couldn't get its dealers back on side, the problem would only escalate. The Broncos' comeback had been nothing short of triumphant, at least on paper. Back in 2021 during Trump's first term, it was hailed as a bold rebirth of an American classic. Ford marketed it as the return of rugged Americana, and the message resonated. Dealers couldn't keep up with the demand and buyers were willing to pay well above sticker price. Wait lists stretched for months and the few lucky enough to snag one flaunted their good fortune. But just a few years later, the Bronco had become an emblem of disappointment. What was once a symbol of triumph now stood as a stark reminder of hype. Ford had pushed scarcity marketing to its limits. The message was clear: the Bronco was exclusive, special, and worth every penny. Yet as production ramped up to meet the endless demand, something changed. The market cooled faster than Ford could react. Instead of holding its value, the Bronco became just another SUV. One Colorado buyer remembered paying over $65,000 for a fully loaded Badlands edition. Just 3 years later, that same model was listed online for under $48,000 brand new. The owner, feeling betrayed, lamented, "They sold us on rarity, on being part of something iconic. Now it's just another overpriced ride no one wants." Jeep, Ford's old rival, saw the shift and adapted. The Wrangler Rubicon, known for being rugged but simple, suddenly looked like a better investment. While Bronco prices fell, the Wrangler held steady. Jeep's consistent pricing strategy, bolstered by Canadian steel credits championed by Prime Minister Carney, kept costs in check. Ford's short-sighted hype strategy had backfired. Inside Ford, emails revealed that executives were debating whether to temporarily halt Bronco production. They knew that flooding the market had shattered the illusion of exclusivity, yet no one could agree on whether to save face by slowing down or risk deeper losses by pushing forward. The Bronco's fall wasn't just about a single model, it symbolized a deeper flaw in Ford's vision. F-150, from king to castaway. For over 40 years, the F-150 reigned supreme as America's best-selling vehicle. It wasn't just a truck, it was a cultural icon, a symbol of hard work and dependability. Farmers, contractors, and everyday drivers alike trusted it to get the job done. But as the economic landscape shifted, the F-150's unshakable dominance began to crack. A sudden pricing paradox emerged. High-end trims like the Lariat and King Ranch were discounted by up to $10,000, while the more affordable XLT models were suddenly priced under $50,000 for the first time in years. For many loyal buyers, the deep rebates raised a troubling question. If the truck was so reliable, why was it being marked down so drastically? The discounts didn't signal value, they screamed desperation. For farmers in Iowa, the F-150 had always been the backbone of daily life. Yet with Trump's tariffs raising diesel prices and the cost of upkeep growing, even die-hard fans started to reconsider. Some turned to Ram and Silverado, which offered more straightforward pricing without the wild swings. The once unshakable loyalty to the Ford brand was eroding as buyers became wary of committing to a truck that seemed to be losing its place at the top. In the rural Midwest, dealerships faced an identity crisis. The F-150 wasn't just another vehicle, it was a statement of American reliability. Seeing it gather dust on the lot felt almost unpatriotic. One dealership in Kansas held a weekend-long Save the F-150 event, but turnout was sparse. The impact went beyond just sales figures. Ford's logistics team flagged that warehouses and overflow lots would reach capacity by Independence Day if the trend continued. Despite all the incentives, buyers just weren't biting. The F-150 was becoming a symbol of corporate miscalculation rather than American resilience. It's eroding confidence in the entire American auto sector. Dealerships already struggling with marked-down trucks faced increased pressure as prospective buyers questioned Ford's stability. The word bankruptcy surfaced on forums despite the company's insistence on a robust turnaround plan. Insiders hinted at cost-cutting measures, possibly including layoffs at the Rouge Electric Vehicle Center. Yet without a clear path forward, Wall Street remained skeptical. Ford wasn't just losing money, it was losing control of the narrative. The EV price war cannot be won. The electric vehicle landscape had shifted, and Ford found itself ill-prepared to navigate the change. The catalyst was Tesla, with Elon Musk announcing successive price cuts on models like the Model Y and Model 3. It wasn't just a one-off strategy. Tesla's vertical integration allowed it to manufacture at lower costs, and software updates kept even older models relevant, while Ford's EVs lost value the moment they left the lot. Teslas were holding strong. Then came the next blow. Chinese automaker BYD, already dominating the Asian market, began pushing aggressively into North America using duty-free Mexican assembly to dodge some of Trump's tariffs. BYD flooded the market with affordable electric cars. Some models were priced as low as $15,000, making them accessible even to budget-conscious buyers. Meanwhile, Toyota, under the guidance of Canadian Prime Minister Mark Carney's clean tech incentives, launched a $13,000 all-electric SUV, immediately undercutting Ford's entry-level models. Ford couldn't play the price-cutting game. Every time competitors dropped their prices, Ford had to make a hard choice: lower its own prices and incur massive losses, or maintain pricing and watch its market share shrink. Without Tesla's vertical control over battery production and software or BYD's mass production efficiency, Ford was stuck in a lose-lose scenario. Even as the Lightning's price increased, its perceived value declined. Buyers expected more for their money, but what they got was a truck that couldn't meet real-world expectations. Frustration grew as customers saw cheaper alternatives with longer ranges and better charging infrastructure. Ford's electric strategy, meant to position the company as an industry leader, was backfiring spectacularly. Rumors surfaced that Ford was quietly negotiating with a South Korean battery giant to secure more affordable components, but there was no official confirmation. As prices continued to slide and Ford's electric vehicle market share dwindled, analysts began to question whether the company could survive in the electric age. Costly miscalculations, the production blunder. Ford's problems weren't just about electric vehicles. The company's entire production strategy had gone awry during the pandemic. When demand surged, Ford ramped up production anticipating sustained consumer enthusiasm, but the bubble burst faster than expected. Even as showroom traffic slowed, factories kept churning out trucks and SUVs, leading to an inventory glut. Forecasting errors played a major role. Ford's spreadsheets had projected that demand would continue at pandemic levels well into 2025. Executives believed that post-pandemic recovery would boost consumer confidence, but the reality was starkly different. When chip shortages ended, production accelerated just as consumer interest waned. The result was a massive backlog of unsold vehicles. Ford's factory inertia compounded the issue. Shutting down a production line, even temporarily, is costly. So rather than risk idle plants, the company kept manufacturing, filling up lots and contracting with farmers to store trucks on open fields. A satellite image of one such makeshift storage area went viral, showing hundreds of brand-new F-150s parked in rows on a disused cornfield. Internally, supply chain managers warned that over-ordering semiconductors and parts could lead to financial fallout. Still, leadership pushed ahead, fearing that slowing production would signal weakness. To make matters worse, when some dealerships refused new shipments, Ford executives saw it as dealer resistance rather than a sign of market saturation. A leaked slide deck revealed that the Rouge complex might face layoffs if the backlog persisted. The memo also suggested selling some of the surplus vehicles at deep discounts directly through Ford's own channels, cutting dealers out entirely. This idea caused immediate backlash as dealers saw it as a betrayal of the franchise model. Ford's inability to balance production with real-world demand wasn't just a strategic mistake, it was a failure to recognize how quickly consumer priorities had changed. Internal strife, a company divided inside. Ford's boardroom tensions had reached a boiling point. The company's leadership was split between two factions: the Model E evangelists, who believed that electric vehicles were the future, and the Heritage Guardians, who wanted to double down on traditional trucks and combustion engines. CEO Jim Farley found himself straddling the line, advocating for the Ford Plus plan, while also trying to appease the traditionalists who feared the company was abandoning its core identity. The conflict wasn't just philosophical, it had real-world implications. The EV division was bleeding money, while legacy models still accounted for the majority of sales. Farley tried to position Ford as both a traditional automaker and a tech-forward company, but the dual identity was causing confusion both internally and externally. High-level resignations made headlines as longtime executives walked out, frustrated with the indecisiveness. Scene 8, steering two ships. One vice president was quoted as saying that the internal dysfunction was like trying to steer two ships with one rudder. Scene 9, engineer uncertainty. Engineers felt stuck, unsure whether they should prioritize next-gen electric drivetrains or improve classic V8 engines. Scene 10. Dipping morale. Morale within the company dipped as rumors of restructuring spread. A departing vice president reportedly warned, "If we keep fighting ourselves, we're just handing the industry to China on a silver platter." Externally, Ford attempted to project confidence, but leaks from within told a different story. Bloomberg reported on internal memos discussing potential spin-offs to separate the electric vehicle and legacy divisions entirely. The idea was met with mixed reactions. Some saw it as a lifeline, while others viewed Ford's internal conflict wasn't just about cars, it was about identity, heritage, and survival. The division within leadership only amplified the sense of instability that was rippling through the entire organization. A glittering ballroom in Riyadh seemed at odds with the economic earthquake reshaping global markets. Delegates from 20 nations, exuding the polished confidence of seasoned politicians, gathered beneath crystal chandeliers to sign a charter that would redefine reserve currencies. The new composite 30% Chinese renminbi, 20% Japanese yen, 15% Russian ruble, 10% Indian rupee, and the remainder split among gold bullion, energy bonds, and pan-regional funds. Brazil's central banker, speaking into a bank of microphones, emphasized that diversification was not a provocation, but a defensive move to survive American volatility. Meanwhile, European observers whispered that with the dollar dethroned as the sole safe haven, other currencies would vie for dominance. As the ink dried, the central question lingered: had the United States lost its financial grip on the world? As automated trading algorithms adjusted to the new reality, back-office executives and financial hubs like Singapore, London, and Johannesburg monitored surging orders for renminbi assets. A senior fund manager admitted to underestimating the political determination driving Asia's financial realignment. Across the Atlantic, a Treasury official privately acknowledged that Washington needed more than threats to counter this new coalition. The dollar, once unchallenged as the world's reserve currency, now faced its most severe test in 75 years. Shortly after the Riyadh summit, new financial systems began quietly humming in the background of global commerce. These payment rails bypassed SWIFT, using blockchain-like ledgers to facilitate transactions in local currencies. An Indonesian palm oil exporter posted a notice prices now payable in composite units per new reserve basket formula. In Paris, American tourists noticed menus listing prices in euros, yen, and renminbi, with a note dollar transaction subject to a surcharge. A professor of international law described it as a watershed. Reserve rotation signals the end of monetary exceptionalism. Such academic insight carried weight as institutional investors recalibrated risk models to account for the shifting financial landscape. Consumer apps in Tokyo, Kuala Lumpur, and Dubai began displaying exchange rates no longer pegged solely to the dollar. A cafe owner in Lisbon noted his wine shipments now cost 30% more when priced in dollars compared to euros. Liquidity pools shifted toward regional bonds, confirming that the multipolar era was not merely theoretical, it was unfolding. Calls from Washington to G7 partners went unanswered. The new financial framework had slipped from American control, and the old order was buckling under diversified interests. As the dollar's reserve status eroded, the White House scrambled to respond. The Federal Reserve slashed interest rates by 50 basis points in a televised address aimed at restoring global confidence. Simultaneously, selective tariff rollbacks targeted European goods in a bid to coax Brussels back into alignment. Yet opposition leaders in Congress condemned the measures as too little, too late, accusing the administration of failing to grasp the deeper issue diminishing global faith in American economic leadership. Despite a brief market rally, bond yields soon rose as skepticism took hold. One White House aide compared the response to fighting a prairie fire with a garden hose. Leaked memos revealed internal fears that piecemeal concessions would only encourage further de-dollarization. Financial analysts mocked the efforts as reactive rather than strategic, warning that once global trust fractures, it cannot be restored through symbolic rate cuts. The overarching fear superpower status without reserve currency dominance might prove as hollow as it was precarious. On the New York-Shanghai trading livestream, commodity brokers observed oil futures pricing risk in the new composite units instead of US dollars. A quiet but monumental shift. Southeast Asian development banks reported increased demand for local currency loans funding infrastructure projects through bonds issued under the new agreement. Back in Washington, strategists weighed potential countermeasures, from innovation grants to renewed diplomatic engagement. Yet the key question remained: Could the United States reinvent itself through technology leadership and global cooperation, or would it cling to fading financial privilege? The initial patchwork interventions proved insufficient against the sweeping resolve of the new alliance. As the narrative shifted from whether dollar dominance would end to how the global economy would adapt, a stark reality set in. When the currency that built an empire no longer ruled, the story of economic power would be rewritten. The world awaited the next chapter, uncertain of who would wield the pen. But what do you think? Let us know in the comments.